What is up? Today I'm going to be teaching you everything you need to know about Forex leverage. I remember whenever I first started trading, I watched at least 20 videos on leverage, and I always seemed to be more confused after watching them than I was whenever I first started. So if that sounds familiar, then no worries. I guarantee that today's video on leverage will be the most simple and easiest to understand out of any leverage video you've ever seen. If I'm wrong, feel free to click that dislike button, but if I'm right, then you got to click that like button and you got to subscribe here to TTC. Deal? Awesome. Before we get started, I have an exciting and important announcement to make. We just finished building what I consider to be the best Forex education on the planet. Now, I know that's a bold statement, and yes, I'm a bit biased, but I'm not exaggerating at all. This is called the TTC Forex University. And next week, we will be releasing this to the public. But we are only looking for 300 motivated traders for this initial early access launch. And these 300 traders will be receiving a massive 75% off discount on the university. So if that sounds interesting to you, then go to ttcfxuniversity.com, put your email in so that you're notified when we launch and you can go ahead and grab your spot before space runs out. If not, then no worries at all. I'm gonna let the intro and disclaimer roll and I'll be right back to teach you everything you need to know about Forex leverage. Hey traders, and welcome to our lesson on leverage. At the beginning of this video, we're going to go over the most simple concept, which is what is leverage. But by the end of the video, you'll know how to implement leverage into your trading in the safest way possible. So let's go ahead and get started with what is leverage. Leverage is the use of borrowed funds from your brokerage in order to have a bigger position size than you would be capable of having with just your cash balance in your account. Let's make this simple by doing a table with the most common leverages that are offered by most brokerages. So this table is going to look like so. We're going to start out with 10 to 1 leverage. We'll go to 20 to 1, which is our next most common. We will then go to 50 to 1, which is also a common leverage, and we'll go all the way to 100 to 1. These are the most common leverages offered by most brokerages, and it's very simple. One is equal to your cash amount in your account. Your account balance is 1. So in this situation, let's just consider that you have an account that's a $100 account, and on this side is your leverage / margin. So if you have a $100 account, and this is also called buying power on this side. So if you have a $100 account, 1 to 10 leverage would be what? $1,000 of margin or buying power. 20 to 1, easy math here, $2,000 of buying power or margin. 50 to 1, $5,000, and 100 to 1, you would have $10,000 of margin or buying power. This is what the brokerage does for you, and one of the most common misconceptions is thinking that because you have 1 to 100 leverage on your $100 account, that you have $10,000 that the brokerage is going to allow you to lose. That's not the case whatsoever. And to help clear this up and to help you understand better what leverage actually does, I'm actually going to do a example on the screen. It's going to be an analogy and a drawing for you because I think that's going to be the best way for you to understand this. But go ahead and take a screenshot of this table if you would like to. This is what it means. It should be pretty easy. You just multiply 1 as your account balance times the amount of leverage you have, and that equals your margin or buying power in the Forex market. Okay, so now for our analogy. Let's say we have your brokerage right here. I'm going to make it look like a bank, a terribly drawn bank, but you get the idea. This is your brokerage. Let's say this is you right here, the trader. And let's say this is the market. Let's just call it your investment, right? INV. And in this case, I can actually write out investment. And we're going to call this investment stocks because it's going to be a lot easier of an analogy without using the calculation of pips in this specific lesson. We are going to talk about the calculation of pips later on in the video, but this is going to make it a lot easier for you to familiarize yourself with the idea of leverage. So first thing that happens is you open an account with this brokerage. So let's say you open this account We're going to keep math really simple and say you open an account with $100. Let's say that this specific brokerage gives a 1 to 50 leverage, meaning that your $100 is now $5,000 of buying power. So what does the brokerage do? They now give you $5,000 of buying power. Notice I didn't say they give you $5,000 to spend on whatever you want. This $5,000 has to be invested into investments that you think are going to rise. In this example, we're doing stock market. For Forex, obviously it would be Forex, and let's just stick to this example. So for example, this brokerage, you would give them $100. They would go, we give you 1 to 50 leverage, so we're going to give you $5,000 to spend, in this case, in the stock market. Now, let's say you, as the investor, see a stock, let's call it stock A, and stock A is at an evaluation of $1,000. Here's the benefit of leverage. Without leverage, you have $100, you could not even buy one stock of stock A. But with leverage, what can you do? You can now buy 5 of those stocks, because $1,000 times 5, obviously 5 of those stocks would be $5,000. So leverage gives you the power to have 5 $1,000 stocks. And this bank is going to go, cool, that's totally fine. You have $5,000 of buying power. You can buy 5 of stock A for $1,000. But we will never let you lose more than $100. Let me say that again. Your brokerage says, yep, totally fine. We'll allow it. Buy $5,000 of stock A, but you can never lose more than $100. If you do, we're going to hit you with something called a margin call. So if you have 5 of a $1,000 stock, 5 of them, and this stock goes up $1, what happens? If this stock goes up $1, you make $5, right? That's all you need. So this is how leverage can work in your favor. You're now making $5 for every dollar this $1,000 stock goes up, and without leverage, you never even could have bought in. Now, how does leverage work against you? If this stock goes down $1, what happens? The stock goes down $1, you lose $5. And remember what your brokerage said. We will never let you lose more than $100. So what that means, the math is super simple. If this stock goes down $20, let's say instead of going down $1 movement, we go down $20. So we have a negative 20. If this happens, then you're going to be at negative $100. And your brokerage is going to give you a margin call. They will no longer let you trade. They will take all of your positions off the table, and you will be stuck at 0 in your account. You will lose your entire account value. This is margin working against you. And this is what happens in terms of leverage. I hope this kind of illustration gives you a better idea of how leverage works. You give the brokerage $100. The brokerage multiplies that by 50, giving you $5,000 of buying power. Not $5,000 to lose, not a $5,000 account. You now can control $5,000 worth of a specific investment you think will rise. But your brokerage will never let you lose more than $100. So if this $1,000 stock goes down $1, you lose $5. If it goes down $20, you lose your entire account. Because your brokerage, although it's allowing you to control $5,000 in the market, it's never going to allow you to lose your account value. Your brokerage will never lose money on a deal. So they're not necessarily telling you, hey, you have a $5,000 account. They're just letting you control $5,000 worth of a specific asset. In this example, it was stocks. But in our case, we have to do a little more calculating in order to understand leverage, because we're trading in something called pips, which we talked about a little bit earlier, and in something called lot sizes. And that is what we're going to go over right now. Now that you have this illustration and you understand how leverage works between you and your brokerage, let's talk about how we apply this in the Forex market, and I'll see you there. Leverage itself can be a difficult topic to really comprehend and understand. But don't worry, I'm going to break it down in its most simple form. There's a little bit of math involved, but I'm sure that by the end of this lesson, you will understand leverage to the degree that you need to. There's really not much to understand. What you really need to know and need to kind of be able to comprehend is that leverage is unexplainable without the explanation of what's called margin. Leverage and margin go hand in hand. Let me explain it with an example. Let's say that you have an account, you have your leverage, and you have margin. And what we will do is do examples of all this, and then we'll actually place figurative trades so you can understand what happens when you place a trade on a leveraged account. So here we go with our account, our leverage, and our margin. Let's make things super simple and say we have a $100 account. Let's make it a 50-to-1 leverage because that's what I use is 50-to-1. So we have 1 to 50. For every dollar we have, the brokerage that we're trading with is going to give us $50. That's what leverage means. So right now, before we even move on, what this means is that with our account at 50-to-1 leverage, that's going to be our margin. So we have to multiply our $100 times our 1 to 50 leverage. That means that we have $5,000 of buying power, or what is otherwise known as margin. So what the brokerage essentially is telling you when it lets you use leverage is you can have $100, but we're going to give you $5,000 to trade. But every time you take money out of that $5,000, we will decrease your account by that same percentage, so that you don't really, you have $5,000 to trade with in the markets, but you don't have a $5,000 account just because you're leveraged 1 to 50. It's going to make a lot more sense whenever I do this. Let's say you have this account set up, and let's do a figurative trade. Let's say you want to, here's our figurative trade. Let's say you want to buy 1 micro lot. Hopefully you remember what a micro lot, 1,000 units, or 1 micro of the euro dollar. So what you are saying to your brokerage whenever you say, I want to buy 1 micro lot, is that you want $1,000 of what is known as your quote currency. Your quote currency is a fancy way of saying your account currency. So right now, what you're telling your brokerage is you want 1,000. In my case, it's US dollars. That's what I trade with. So I want $1,000 to be involved in the euro versus the dollar. With that being the case, what your brokerage does is says, okay, cool. Since you're leveraged 50-to-1 and you have $5,000 of buying power, there is no problem with us letting you take a $1,000 trade, letting you purchase $1,000, 1 micro of the euro against the dollar. But we're going to have to take that out of your buying power. So now we have to subtract our $1,000 trade, our micro lot, which leaves us with $4,000 in margin. The brokerage also goes, okay, since your buying power went down from 5,000 down to 4,000, we are also going to take that same exact percentage out of your total account value. This math is very easy to do. All you have to do is, in order to figure out the percentage, is take what you spent, like the 1 micro lot. So you take the $1,000 and you divide it by your overall previous balance, which was $5,000. So you divide that by $5,000 or by 5,000, and what you get is a percentage. What you get in this case is 20%. That math was easy. Do the math on a calculator. Not that big of a deal. Just do the math on a calculator if you want to know all this. Your brokerage does all this for you. I just want to ensure that you understand the way leverage works. So if we took, your brokerage is talking to you again now, if we took 20% of your $5,000 buying power, that means you also are going to lose 20% of your account size. What's 20% of $100? It's $20. So now your account goes from 100 to what? To $80. This is what your brokerage does every single time that you place a trade. That's why I said towards the beginning that it's not like you now have a $5,000 account. You have $5,000 worth of buying power on margin when you use leverage. Hopefully that was pretty clear, but just in case it wasn't, we're going to do one more example now. Let's say we stay right here. We have $4,000, but we have another trade that happens. We've already been through our euro dollar trade. Let's say this one is on the Aussie dollar. So we have an Aussie dollar, and let's say this time we want to purchase 3 micro lots, which means 3,000 units of currency. And when you're telling your brokerage you want 3 micro lots, you're essentially saying, I want 3,000 units worth of the Aussie dollar taken out of my account currency. Your account currency is what matters. My account currency is dollars. So that's me saying, okay, use my buying power to purchase $3,000 of the Aussie versus the dollar, right? So if that's the case, and let me put down AU so we know it's the Aussie dollar. If that's the case, the brokerage is going to go, cool, you still have 4,000 worth of buying power, so we can place this order for you, but we're going to subtract the 3,000 that you just paid for those 3 micro lots, and that's going to leave you with a $1,000 buying power. That's leaving you with $1,000 in margin. At this point, what should we do? At this point, we have to take the money we just spent, 3,000, and divide it by our account balance at the time we spent that money. Divide it by 4,000, because at the time we placed this trade, our account balance was down to 4,000 because of our previous trade on what? On the euro dollar. I think it's 75. Yeah, 75%. So what this means is we just took 75% away from the balance of buying power, from your margin. Since we took 75%, sorry guys, the battery on my camera just died, but this will probably be just as easy without seeing my face. But what your brokerage is saying is, since we just took 75% out of your margin, we now have to take 75% out of your total account as well. So just remember, it's always based on the same exact percent. Whatever you spend in margin, that same percentage, let's say you spend 90% of your margin, the brokerage is going to take 90% of your account value when you do that. It parallels in terms of percentage. So with this being the case and 75% being gone now from our buying power or our margin, we now have to take our $80 that's in our account and we have to take 75% of it away. How do we do that? We multiply 80 by 0.75. We hit equals and we get 60. So that means we have to take away $60 from our account as well, leaving us with a $20 account and $1,000 of buying power while having 50-to-1 leverage. I know that's a lot of drawing on the screen, but this is how leverage works in a nutshell. You got to remember that leverage and margin go hand in hand at all times, and whatever you purchase with the margin, the buying power your brokerage gives you, whatever percentage of that you use, it will take that percentage away from your account. With that said, I'm actually going to charge the battery on my camera and add a little bit to this lesson. So I'll see you guys in just a second. All right, so I got the camera charged and back on. This lesson is going to be a little more to do with the margin side of things, which we're going to go in detail on in the next video. But this is something I do want to go ahead and put into this video so you're familiar with it moving forward. Let's do another example. Let's say you have your account. Let's say you have your leverage. And let's say you have your margin, just like we did before. Let's go ahead and separate all of these. We're going to keep it super simple and say the same $100 account value. We're going to say the same 20-to-1 leverage. And that means you have what in margin? If you have 20-to-1 leverage on a $100 account, that means you have $2,000 of buying power. This is just the amount that you can control in the Forex market. It's not the amount you can lose. Your brokerage will never let you lose more than $100. You will get margin called if you do. But $2,000 is the amount you can control in the market. This will be easier to understand if I do an example. Let's say you're on the euro dollar, the EU. Let's go ahead and make up another one of those figurative trades. Let's say your trade's right here. This is your buy. Say your stop loss is right here, SL. Let's say your target's up here. Now, when we go further into the course, you'll realize that for our risk management plan, we make our stop loss equal to a certain percentage of our account value. That's how we're going to be using risk management, and we'll go over that in detail later in the video. But let's say the size of this stop loss is 10 pips. And let's say that you're going $100 account. I want to risk 3% of my total account value. That means you're going to be risking $3. And I'm just doing this because it's easy math. So you want to risk $3 on this trade, and it's a 10 pip stop loss. What does your position size have to be? I know this sounds like a word problem back in high school, but bear with me. What does your position size have to be to risk $3 on a 10 pip stop loss? Well, let's go back to what we know. We'll do that right over here. A micro lot is equal to what? That's equal to 1,000 units of currency, which is equal to, on most currency pairs, 10 cents per pip that price moves. If it goes up, every pip price goes up. If you have a micro lot, you're making 10 cents. If it goes down, every pip that price goes down, you are losing 10 cents. So if we need $3 on a 10 pip stop loss, that means we need every pip to be worth what? 30 cents. So let's reverse engineer this. If we need 30 cents, then we need 3,000 units, which means we need 3 micro lots in order to fill this position. Here's the problem. Right now, you've probably already called on, do you think you're going to be able to place this trade? Or do you think your brokerage is going to hit you with an error message and not let you place this trade? I know what you're thinking. It's only $3 and I have 2,000 of buying power. Why wouldn't I be able to place that? The reason you cannot place this trade is because you are trying to control more than what your margin will allow you to control. Your buying power, which is just the same thing as margin, your buying power will let you control $2,000 worth of currency. In this example, in this trade, you would have to purchase 3,000 units worth of currency, worth of the euro dollar, in order to equal this $3 stop with this 10 pip stop loss. So for that reason, your brokerage is never going to let you place this trade. I know it seems silly because you're thinking, I have $100 in my account. Why can't I risk $3 of that on this trade? It makes no sense. The reason is because you're sitting there with $100 and 1 to 20 leverage, which means you have $2,000 of buying power. And what you're trying to do is control $3,000 worth of the euro dollar with only $2,000 worth of buying power. Hopefully you're starting to understand your brokerage will never allow you to do that. So as we move forward to help you better comprehend the way leverage and margin work, please try to keep in mind that margin is not the amount of money you have to lose. You don't have a $2,000 account just because you have 20 to 1 leverage. You have $2,000 worth of buying power. It's just the amount of power we have that we can be in control of in the currency market. So hopefully that lesson helped you to better understand the way leverage works. Okay, so now that you know how leverage works in Forex, the last part of this video, I want to explain the right way to use leverage if it's something you decide to do. Forex is risky without leverage. With leverage, it's absolutely more risky, as we've already seen throughout the video. You can lose a lot of money at once. So it's 100% your decision whether or not you use leverage. It can work for you and against you, and you need to use it in a smart way in order to minimize your chances of losing more than you want to in any specific trade and losing your entire account. So what I'm going to attempt to explain here is how to use it correctly. Let's do an example of how to use it incorrectly first, though. Okay, let's take your same $100 account, $100 account. Let's take 50 to 1 leverage this time. Let's take your margin or buying power of $5,000. Now, do you think the right way to use leverage is to put up a position of $5,000 on a specific currency pair? Do you think you should go buy another figurative trade? Let me move this out the way. Do you think you should go buy the EU or the euro dollar, and that you should buy 5 micro lots, which would be $5,000 worth of the euro dollar? What I want you to realize is at this point, every pip that moves is worth what? If 1 micro lot is 10 cents, every pip the market moves is now worth 50 cents. Let's do a little bit of math. What is $100 divided by 50 cents? That would be 200, right? So what we have to realize here is that if you do this on every trade, you are only giving yourself 200 pips of risk before your entire account is gone. So if you're putting up your entire position on every single trade, no matter if you're using a stop loss or not, if you're putting up, what I mean by entire position, if you're putting up your entire account value, your whole 5,000, your whole margin on every single trade, you only have 200 pips before your account's at zero. No matter if you're using a stop loss or not, in total, you can only lose 200 pips and you're going to be completely out of the game. So this is how using leverage can completely work against you and how you can quickly lose money and possibly even blow your account. Don't use your entire amount every single time you place a trade. The correct way to use leverage starts, obviously, with a stop loss. You always want to ensure that you have a stop loss on any trade that you take when you're using leverage. So if you're using leverage, let's talk about the correct way. I shouldn't have deleted all that. Now I got to draw it again, but it doesn't take long. So now, what if we had a similar EU trade? At this point, your first step, again, always have a stop loss when trading with leverage. So you have this set up and you have a stop loss. Let's say your stop loss is 10 pips. If you want to risk a certain percentage of your account, do that. But the smart way to go about this would be to risk a very small portion of your margin based on your stop loss. So if your stop loss is 10 pips, let's say you want to risk $1, right? So 10 pip stop means that every pip needs to be worth 10 cents. What this allows you to do in order to equal that dollar risk, you want to risk $1. That means with a 10 pip stop loss, you're going to need to control 1,000 units of currency. So this trade itself is going to cost you a very small amount of your buying power, not very small, a fifth of your buying power in order to do, right? And if you lose, you're only going to lose $1 if your stop loss fills correctly. This is the correct way to use leverage. Essentially, we're not using leverage to max out on every position. We're using leverage to allow us to be in more trades at once. And you obviously can make more money with leverage being able to control 1,000 units at a time than you would if you could only control what your cash value in your account is. So please, as we move forward in the course and as you continue trading, remember to use leverage in the right way. Hopefully this video gave you a good idea of not only what leverage is, but how you can use it in the right way to minimize your chances of blowing your account or losing more money than you expected by using leverage and margin in Forex trading. I'll see you guys in the next video. Talk soon. So that is going to wrap it up. Hopefully now you have a better idea of leverage and the way it works in the Forex market. Don't forget, the TTC Forex University is going to be released to the public next week. And we're only going to have 300 spots available for the 75% discount. So if you are interested in that, be sure to go to ttcfxuniversity.com. The link is on the screen, and put in your email address to be notified when we launch so that you can go over there and grab your spot before space runs out. Comment below if you made it to the end, and definitely comment below if you noticed how many times I changed outfits in this video. I think it was like 5 times. This video took about 6 days to shoot because every time I was done with it, I found something else that I wanted to add to it, and it just ended up being a complete process in terms of trying to make this video. But with that said, I'm gonna let you guys go. Again, I appreciate your support and thank you for making it to the end of this video. TTCFXUniversity.com if you'd like to get notified when we release our brand new university next week. That's all for now, but I will see you in the next one. Talk soon.